everybody. This is our third webinar that the Lotus Launch team has done. Now we have the amazing Dan Dobbs here talking about assumable loans. And if you know Dan Dobbs, yes, little golf clap. If you know Dan Dobbs and you've heard of Dan Dobbs, he is an amazing blogger that writes a lot about real estate. And most real estate agents who are in the know read all of his content. And he blogs, once a day? Almost?
About 5 times a week, yeah.
Yeah, it's an incredible amount of information. He scans the internet and just different news sources for information that keeps realtors on their toes as we get into the workday and hit the ground running so that we're prepared with great information. And my name is Becky LeBrett. I'm team leader for Lotus Launch. I'm also a broker, and I work with EXP. Our team is powered under EXP. Our whole thing is we love to give educational content to clients and other realtors. And so here we are. We're going to kick things off.
So greetings, I'm Daniel Dobbs. I've resided in California since I came here from St. Louis area, and I got into lending in my mid-20s, and that was a blessed day for me. So these are all my blog stats, some links that you can click on at a later date, but I'd like to thank Becky for having me as the guest tonight, and we're going to give you a quick presentation on assumable mortgages, which are all FHA and VA loans, and USDA. So the Wall Street Journal has done pieces on assumable loans. And the fact is we're at an inventory historical low, and we have a lot of buyers who would like to move up, but they've got a 3.5%, 4% interest rate. And today interest rates are roughly 7% at no points on a Fannie Mae, Freddie Mac loan. VA and FHA are a little different, so buyers are in a quandary. So the Wall Street Journal did a great piece on this, and you can Google this. People that have VA and FHA and USDA, which is United States Department of Agriculture, very rare in Southern California, a little bit out in the Inland Empire. There is an option for them to sell their home at a premium, not have their buyers go through the entire circus of qualifying, for them to get into their next home.
So this assumable loan is, in layman's terms, it's basically when a buyer is able to take on the interest rate of the seller, which could be potentially favorable for them.
Yes, you're inheriting the loan interest rate. Also with an FHA, there's usually mortgage insurance, which is about 0.8, is also tax deductible. But you are inheriting the rate. In that case, it'd be a blended rate, but you're also inheriting the shorter term. So if they've been making payments for 5 years on their mortgage, your mortgage is only going to be 25 years. So that's a big advantage. The end of 2022, and they went up, skyrocketed. So a lot of people were stuck. A lot of offers fell out. A lot of people want to move to a different district for their kids, and they're in a quandary because all their equity is wrapped up, and most people is wrapped up in their current home. So also when you own a home, it's harder to qualify for the next loan, because most people don't like being a quote unquote landlord. There's also a lot of tax benefits for that, but it's harder to qualify for your next loan. I don't want to get into that now, but basically people are kind of landlocked into the loan they're in, unless they want to turn it into a rental. So rates are over 7%, home prices have skyrocketed, inventory is low. And also, the American housing market is getting older, particularly in the East Coast or in the Midwest where I'm from, but its residents are growing older. This is why you see the trend toward ADUs. And I'm going to limit most of my comments to the Southern California market, from Ventura to San Diego to the Inland Empire all the way to the Arizona line, because that is what I know. Lending is a national subject to speak on. However, real estate, I never contradict the real estate agents that I in a referral relationship with, because I'm not really qualified. But by publishing my blog, I do become involved with the issues of housing, land use, tax policy. So Zillow say they're hunkering down. Sellers are hunkering down. They'll rehab their house. They'll add on an ADU. That's not adequate for a lot of a lot of homeowners currently. So the advantages for the buyer, lower rate than what's out there, which means lower payment, and really important, a lower remaining term on the loan. On a 30-year loan, it isn't until, depending on the rate, it isn't until about year 17 or 18, where if you have a $2,000 a month principal and interest payment, it really, the amount that goes toward principal isn't 50-50 until about year 18. You would think 30-year loan, well, it'd be roughly 15. It's not. So the interest is always front loaded on a mortgage. It's kind of like going to the casino. It's a little rigged. So when lenders go belly up, I'm like, well, how can you do that? It's 90% of the payment for the first 8 years is basically all interest. So the lower remaining term of the loan is very important.
Maybe they go belly up because they take it all to the casino. That's why.
Yeah, I have had gamblers for clients and we're like, why don't
gosh.
these people have more money? And then they were like a cash call. And we're like, how does this work? They're compulsive gamblers.
We have a question in from Roger. His question is this also known as sub 2?
Good question, Roger. So assumable loans, there's no option for the servicer and the lender. They are assumable because HUD says so. Mm-hmm. And VA, we'll get into that in a minute. But FHA and USDA, they don't get to approve it or not. Subject to is more in relationship to what they call a wrap. Because of the due on sale clause, Fannie Mae, Freddie Mac loans are never assumable. It's bank fraud. That's it. But you have people in the internet geniuses out there on YouTube saying all the benefits. Well, none of them have real estate or lending licenses. And that's for a reason, because they would lose them very quickly. So subject to is a way around the due on sale clause, but the bank will find out. We live in the age of electronics. It won't take them long. Okay, so people always ask, where are the most assumable loans? Well, first of all, the seller often doesn't know they have an assumable loan. The agent doesn't, because, we've been in an era for 10 years of low interest rates since 2013. So this hasn't come up. So about 40% of the Southern California market is FHA and VA. Now, if you're talking about Newport Beach, the percentage is practically zero. But if you're talking about Moreno Valley and you're talking the lower end of the starter homes or condos, then it's well over 40%. So that's the way to be thinking about this.
This stat was really interesting to me when you shared this. I was surprised that a lot of the VA FHA that are assumable are in Southern California. Is it a population density thing, an income thing? Is it?
VA buyers typically get in with 3.5% down. Everybody wants to get in with the minimum, whether you're trying to leverage money or you just don't have the down payment. Adding more money to the down payment, unless you're up to 20%, and that would be on a Fannie Mae loan, doesn't really lower your payment that much. And when every person buys a home, whether you're single or you're a couple or with children, you're going to get in the home and want a nest. It's just the nature. So people should put the minimum down and then get in and customize the house the way they want it. No matter how perfect a home is, all things being equal, people are going to want to customize their home. So there's some advantages for the seller. Like we had Loan Depot send us a 2-page letter, and I don't do the assumables. My colleague does that they weren't going to honor the requests for assumables. Okay, well, then we just call HUD. You were crazy, Loan Depot, who's not a player in anybody's mind. They're based in Southern California in Foothill Ranch, but fundamentally, they're like, we're not going to cooperate. Well, you will because HUD says so. But there are some advantages for people, for servicers, and that is they get to keep that loan. They don't have to go out and find a new client because, as we know, there's not much real estate activity out there now. So they protect their portfolio. So the assumption is required. It's not an either or for companies like Loan Depot. Why they would send us a 2-page letter saying these are the reasons why we're not going to do it. That was charming. Let's just say it was charming.
So they're trying.
They don't want to gear up for it.
Okay.
Yeah,
they just too much work that they don't get paid on. I know sometimes that's a
it's a tedious process. They have to go to the bank, then they have to go through all these documents, and they don't really make any money on this. Exactly. They make money by lending new loans. By the way, Loan Depot, as far as making loans, they're a pretty good shop, but they're not set up to service loans. So that's what I mean by they're not a player.
Right.
because they're just not set up to service loans. And by servicing, I mean collecting the monthly payment and dispersing funds and things like that. They're just not set up for that.
That's actually an interesting point, the difference between the lender and the servicer. So when there is an FHA or VA assumable loan, at what point is the servicer involved in the process, or are they involved in the process?
From the very start.
Okay.
And that'll be up in the next frame, I think it is. We'll cover that. So let me digress to a VA. VAs are really straightforward. Every lender, I don't care who they are, no, they are well aware that they have to cooperate. So because VA will come down on them like a ton of bricks. And what they do is they remove, let's just say X, Y, and Z mortgage says we're not going to cooperate. Then VA says, then you can't sell us and fund any VA loans. Good luck with that. VA is a little bit more nuanced. With the VA loan, every veteran has an allotment, if you will. So there are no loan caps. Whatever a veteran qualifies, if it's a $5 million loan and they can qualify for that, the VA loan will be $5 million. If another veteran assumes a selling veteran's loan, the entitlement for the selling veteran isn't reduced. So there's a whole formula and it's kind of complicated. The veterans have a calculator on that. But veterans would prefer another veteran to assume their loan because it doesn't get crazy. Also, what I have found, I've only worked with the Marine Corps down at Camp Pendleton as a volunteer service organization as part of that. My family's Navy, lifetime. And veterans have a camaraderie between each other. With the Marine Corps and the Navy, it's a competition. So they would rather see another vet assume their loan than not only because of the money thing, but because it's just part of the veteran thing.
But they also lose their benefit if a non-vet assumes their loan. Is that correct?
Well, they could lose it or it will be reduced. And so I've had one veteran who actually was a Vietnam veteran because each year it tends to increase. But they were homes in like Mississippi that were $80,000 a piece. And he got transferred all around the South. And so he ended up buying a third home and still being able to use his VA because the other homes were so inexpensive. I don't know where anybody has an $80,000 home anymore.
So for the assumable VA loans, it's ideal for a veteran to assume those loans versus a non-vet. But it still can be assumed by a non-vet and preferably a vet.
Preferably, that will be their preference. But yes, a non-vet can assume it.
Right. So all the veterans out there, consider your buying options. That you could definitely assume a property that has a VA loan. So that could be pretty awesome for you.
So oftentimes when a seller has a home, if it doesn't sell conventionally, there's usually two reasons. One is it's overpriced. But in today's world where so many people pay cash, that's trending down now, according to Fannie Mae and Zillow. Or it's the condition of the property. We have a lot of mold in Southern California. That's a deal killer. That doesn't mean a young couple comes in and wants to put a bunch of sweat equity by tearing down the sheetrock and gutting the house. If you can't get an appraisal or an inspection waiver, then you're kind of stuck with that house. I had a client that bought a home and unbeknownst to them, it was undisclosed that the house had been a marijuana grow farm out in Temecula. So slap in a coat of paint, new carpet, everything looks great. Till right before escrow, we get inspection that the selling agent, the listing agent had been holding off on. And we're ready to draw loan docs and there's mold all over the house. Well, that killed that deal. However, for the seller, and I'm not sure we ever really know who that was because I'm not involved in that side of the transaction. But the whole house had to have all the sheetrock, all the walls just torn out down to the studs, redone. The house had to be tinted, termited, all over that stuff. That house was virtually unsellable. So they ended up selling it to some investor that probably paid 40 cents on the dollar.
Right.
So that was a big problem. So you don't have a lot of these problems on a fixer. That's an extreme example of what I quoted. So a lot of homes have other issues. Remember, Americans are getting older. It's the grain of America for homeowners. The homes are getting also older. So you get a young couple who comes in, they've got all the energy that a young family has, and the house is, for whatever reason, doesn't pass inspections. Doesn't have to be that extreme. Also, you have a property that was a rental. Let's say as the renters moved out, there was a squabble, there was a disagreement, and they decided to start ripping out the fixtures. It happens. So in this case, we don't have to have a new appraisal. Buyers can come in and take it as is.
Okay. So one of the huge advantages for the seller and the buyer that there is no new appraisal that's needed. There's no inspection that's needed either with that transfer. Is that correct?
Correct. So you can really buy a fixer, where with VA, FHA, and Fannie, when you're just buying a typical property, you have all these inspections, the appraisal, and you can't buy a pig in the poke.
Yep.
Also, that broadens the larger pool of buyers. Like if people are self-employed and they have a lot down, let's say they have $200,000 down on a $500,000 property, and the loan is $400,000, the seller gets their $100,000. However that works, it's called the gap. Whenever you have self-employed buyers, first thing I ask them is, do you make a lot of money? And before I can say on your taxes, they always say, well, I make a lot of money. Yeah, that's a problem when you go to qualify for any loan, including a car loan or a rental property. So self-employed buyers have often what we call mattress money. I've had people have gold Cougarons that we had to Xerox and then get appraised. This was 20 years ago, right? I don't think they'd get away with that now.
Oh, okay.
That was crazy. That was an extreme. But I've seen it all in 40 years.
I bet. You've got some stories when we've been on the phone.
They had suitcases of money, and the guy's, he's 55 and his wife's 25. And I'm like, suitcases of money.
Now it's cryptocurrency. That's going to be another webinar for us later.
Yeah. Okay. This guy's a cartel member or something, right? So yeah, I backed out of that deal. So you have undocumented workers here, and they'll go in as a family, but they don't have a social security number, but they do have a credit score. The important thing to remember on the assumptions, the only real floor that you have is a 640 FICO score, mid-score. Also that there's no foreclosures, open collection accounts, or IRS liens.
So you can have an I-10 and have a 640 credit score and still be eligible for this assumption.
Yes, for the people who are here yet that aren't documented, quote unquote, that they just go down to Wells Fargo, put $500 in a savings account, and they get a credit card. And then they use it for a year, and they'll have credit scores. They'll have 3 credit scores. So you need 2 open accounts. But so that's another example of people that it broadens the buyers. So those are probably the 2 most important buyers that normally can't buy that can, because they will become documented. There will be immigration reform. There was under Reagan. There will be again.
Yeah, no, this is fantastic. I think that's great that it opens up the potential for other buyers. But again, they have to be primary residents, primary occupants of the home. They can't be an investment property, anything like that.
Correct. They have to live in the property for 12 months, and FHA and VA do come out on their own. They don't hire a service. There's actually government employees that come out, knock on the door. By the way, if they've already come out to your door, they already know that you've been playing fast and loose. That they already know, right? It's an electronic thing.
No Nest cameras will be able to deter them, guys.
That's just coming out to put bracelets on your wrist, and the bracelets aren't from Nordstrom's, and the FBI agent doesn't look like Dakota Fanning or whatever her name is. I forget in that movie. So, lesson to take away from this is you don't mess with the federal government and their loans.
Don't mess with the Fed.
So it does bring a lot of new buyers in, and they're going to be less price sensitive because you either get terms or price. With assumable loans, you're mostly getting terms, but you're also getting a lower rate. Okay, so realtors are paid just like a normal transaction. They just don't have to worry about an appraisal. And also an assumable loan, now people can do it on their own, and I've had agents do it. And the one agent emailed me, she'd rather have done her own root canal because it was a nightmare. And I can tell it was 120 days. but it was family members. By the way, another group of people, and I have one going on right now, couples divorce. You have two people that qualified for the loan, but now one person is moving on with, both people are moving on with their life, but one person may want to reside in the property. So the one spouse that's staying at the property can assume the loan without qualifying. That's another third party. Mm-hmm. So you don't have to worry about requalifying for a new loan. It's also cheaper. The service that I refer to is FHA Pros. They charge $2,500 and they just do everything. Agents don't have to do a thing. And truly, you don't, it's like a short sale on steroids. You just don't want to go through that route. So it allows realtors to market the home to more people, and the listing agents win because you get in on a lower rate. Yeah. And if you're an expert, you have expertise in this area, more people will seek you out for your expertise. Buyers must qualify on credit. They have to have enough income to make the housing payment. So you can't go in there and say, well, it's usually just a pay stub and a 1099. Like, they don't even ask for tax return. They can, but they don't. They just want this to go smoothly. So the banks must cooperate, and they must get a seller consent form. So the seller, that's about the only thing you have to do is sign this, so that either the agent or whoever's doing the assumption can call them and say, I have the authorization to conduct this transaction. Okay. Buyer must live in the home. Covered that. Mm-hmm. Only FHA, VA, and USDA loans are assumable. Reverse mortgages or an FHA loan, they are not assumable. By the way, there are now second trust deeds, reverse mortgages available. I'll let you know in the future. So VA sellers may or may not want to have a non-veteran assume their loan. We covered that earlier. Generally speaking, you're going to have a down payment of about 20%. That money can be all gift money. Unlike Fannie Mae, which requires 5% of the seller's own money, and the money needs to be seasoned, accounted for where it came from, not with an assumable. You got the money, we're there. But if they don't have the 20%, it's otherwise known as the gap, which is the last bullet point, then they're going to have to qualify for a second trust deed. Let me give you an example. The assumable loan is $300,000, but it's a $600,000 sales price. The buyer is only going to get a second trust deed of 85% of that $600,000, which is $510,000 if my math is correct. So they're going to have to come in with the $90,000. Now, they're also going to have to replenish the buyer's set-asides, otherwise known as an impound account. So if the seller has 6 months of taxes, they're going to have to also pay the seller for that impound account that's being held on by the lender. Lender will still hold on to that money, but the seller is going to want that money reimbursed to them. Also for insurance. So I don't want to get into that minutia. So I tell people you're going to need about 20% of the sales price to get into the home. There could be some exceptions. I don't want to go into the minutia there.
And again, we have a couple minutes left, but I want to make sure that everyone knows that they're going to be able to connect with Dan afterwards. There's a couple more questions that are coming in about refinancing and getting some advice from you about the cost to refinance.
Sure.
So want to make sure that we make those connections, which we will at the end of the call. But let's continue to roll through a little more. Keep your questions coming, and we'll make sure that they're addressed, whether on this webinar or via email. From Dan to you or from me to you.
So we just rounded off at $1 million, and it's very similar to the situation I gave you. So, if you're inheriting a loan of 3.5% of $600,000, it's half of what you would be paying in today's market, which would be roughly 7%. Plus the loan is only going to be 27 years. Now, by the way, nobody has a loan for 30 years. Because you would pay it off. It's all principal at the end. But most people refinance to pull cash out, put their children through college, to rehab the home. Think about any home that you've been in for 30 years. My family has one back in Illinois across from St. Louis. And yeah, that place needs some work. But the loan, the amount of amortization, which means the amount of principal reduction on each payment, grows fractionally. The shorter the loan term, the better. So in this case, $400,000 would be known as the gap. We could get a second trust deed, otherwise known as a piggyback loan. And here's the downside of a piggyback loan. It's usually a 15-year loan, and the interest rate, instead of being 7%, is going to be 11 or 12. That's the inherent risk of second trust deeds. Let me also mention something that the internet geniuses on YouTube thought this are promulgating, is that when you assume a loan, I'm very intolerant of people who pass on hearsay. So that's why you read my blog. So fundamentally, they were like, well, you've got to start paying the new payment as if it's a 27-year loan. No, you inherit the interest rate and the payment. It doesn't go up because the loan term is less.
Right.
So I found a lot of
there's
lenders,
no recasting or anything like that
right,
once you assume the loan. Yes, that's right.
Yeah, I just found a lot of people that were current MLOs have a million reasons why assumable loans don't work, and it's because they don't get paid on it. So we're going to throw around all these.
That's what I was finding too. So where can people go to start finding these properties that could be assumable, whether buyers or realtors? Where would you suggest?
FHApros.com has them. They're the service who provide them. Probably the best thing to do is just email me, tell me what county you want, give me a zip code, and let me go to them, and then I'll make the connection to them and my colleagues who get into the minutia of this.
Amazing.
So just dandobbs6@gmail.com.
Special thank you for all of you for joining. Thank you so much, Dan, for just giving your, expertise. 40 years in the business. That's amazing. Thank you so much.
I'm a survivor, but thank you for having me. Very kind, and you ran a great meeting. I hope you can show me how to do this for next week.
Oh, absolutely. Thank you all so much.
Thank you all. Bye-bye.
Okay, take care.